Welcome to the art and science of trading as a business. First, I want to talk to you specifically about the program itself and what it hopes to achieve and what the objective of the program is. The objective of the program for the first part is the Money Every Month program is to generate just what it says, money every month. We want to generate a consistent income on a monthly basis in our trades so that just like any other business, we want to generate recurring, consistent monthly income. Does that mean we're going to be profitable every month? Maybe not. Maybe we will. The important point to think about is that we really want to have a monthly income stream. In order to generate a monthly income stream, we're going to be using options as our primary trading vehicle. Now, every business manages their business based on numbers, and that's exactly what we're going to do in ours. This is a real business. It's a business in which you are buying and selling. Any business that buys and sells things, and it doesn't matter what it is, it could be a bakery, it could be a auto repair shop, it could be a parts store, it could be a gift shop. You have to buy your stock from someplace and then you sell it to a customer. Well, the very same thing happens in the market. You're buying and you're selling. Let me give you an example of how we actually try to make our money in the markets as a business. All we're doing is really meeting supply and demand. Let's take, for example, a stock such as Activision, which we have on our screen right now. The symbol is ATVI. It's currently trading at $27.23, down 27 cents today. Now, for the most part, you have people in the market who believe that ATVI, Activision stock, is going to go up. You have other people who believe the stock is going to go down, and that's what makes a market. On the if we take a look at this, the options on this particular stock, we have what's called call options. We have puts. Calls are those options that people purchase if they think the stock is going to go up. People buy puts on this stock if they believe the stock is going down. So let's say you think that the stock is going to go up. So you purchase this call option on the May options for Activision, and you get it at 40 cents, almost in the middle of the bid and ask price. Well, at 40 cents, this option actually has no real value because the current price of the stock is at $27.23. So not only do you have to be accurate as to your timing, because the stock would have to move quickly in order for you to make money, but you also have to be accurate as far as direction goes. The stock has to move up in order for you to make money. If you were to purchase a put option, let's say you got it for 70 cents, not only would you have to be correct as to the direction of the stock, it would have to move down in order for you to make money, but your timing would also have to be correct because it would have to move down relatively soon in order for you to make money. Because there are only two absolute rules of the option markets. Those two absolute rules are, number one, prices will fluctuate. Yes, the underlying price of the stock will fluctuate and the individual option prices will fluctuate. Number two, the only other rule, absolute rule of the option market is that these contracts will expire. Any option contract that you buy on any stock will expire at a certain date in the future. If we were to purchase these May options, the ones that we're looking at right now, expire, and we have the expiration date right here, in 24 days. Normally, the options expire on equity and index options the third Friday of each month. That is the last trading day for those options. They actually expire the very next day on a Saturday. You can also pick the expiration dates that you're interested in purchasing. So, for example, if you thought there was an imminent move in Activision, you could purchase this option for 40 cents today at $27.50, and if the stock did move up beyond the $27.50, you would actually start making money. But what happens if the stock doesn't move? Well, if the stock doesn't move, slowly, day by day, this option that you purchased, if the stock does not move, would slowly erode in value. Why? Well, the reason is that you have the right as a call buyer to purchase the stock at the strike price that you purchased, in this case $27.50, at any time before the third Friday of May. As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. So, I mean, if you take a look at an option like this over time, let's say that the stock doesn't really move. If over time, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact, that the stock did not go up in price, that you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit. Because they sold it to you at 40 cents, they can buy it back at 10 cents, making 30 on that trade. Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, then eventually this option will be worth less and less each week. Let's say next week at this time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only worth 35 cents to 45 cents. Now another week passes by, and it's only 25 cents. See, as long as the stock does not move, these options, all of these options will continue to decline in price.